Good morning and welcome to the Capital Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Peter Stokes, CEO. Good morning to you, sir.
Good morning and thank you. Welcome to the conference to discuss the Capital Limited H1 2024 results. I'll take you through at a high level, given that the presentation has been up for a week or so, we're probably focused more on the questions after, but I certainly want to talk through some of the programs we've got underway and some of the things that we are doing in order to continue to drive growth and returns in the business. I'll just flick through the standard disclaimer slide, read that at your own leisure, but nothing untoward in there. On the results, I'll let Rick go through that as a bit further into the presentation. Key takeaways, really, revenue continues to grow in the business, still have a strong EBITDA in the business, and this year we're declaring an interim dividend of 1.3 cents per share. Really, the key focus for the discussion today is around the highlights of where we've been driving the business over the last while. And I might just go and start down at the Sukari mining contract because I know it's been a discussion for a while. As we talked about in one of our previous investor discussions, the Sukari contract was due to finish in the middle of the year. We received a variation for several more months on that contract. And that will now run out at the end of September. We've had a very successful contract with Sukari. We've overperformed. We've had exceptional safety outcomes, but that will finish that contract. We have extended the drill and blast contract, and that will go for another 5 years from January 2025. Which we're very excited about and continue that long-term relationship with the Centamin business, particularly at the Sukari mine. We've also been very conscious that the Sukari contract would likely finish on the mining side and have been very proactive in driving growth in the broader business. I'm really pleased with where we've been able to grow into the US with Nevada Gold Mines, the Barrick Newmont joint venture, a very large contract for us. We're in the process of ramping up both the drilling and the assay business that we're doing there. That will constitute 10 drills when fully implemented, and we're about halfway through that implementation. When a little bit behind where we wanted to be, and hence the transition of the business, we're about a quarter behind on both of those contracts for a number of reasons. But I think I can see clear visibility to first samples through the lab in late September, early October. Critical part of our growth with 2 Chrysos units then being on the ground later in the year, and the wet chemistry is planned in the middle of next year. The drilling contract, we've got 5 of the 10 drills now fully operational, and the next drills arriving and being mobilised over the coming weeks. We've also been very successful in winning a number of other key contracts, both with current customers, and mainly with current customers, and extending work at a number of our sites. There are a number, Lumwana, with Barrick in Zambia. We're back in Zambia after a number of years. It started off with 2 RC drills there doing deep drilling. We've also won the Nyanzaga project with Perseus, which will be 4 drills working there, which have just started. We've also expanded our operations at Reko Diq and now have 6 drills on the ground there. And we've also, as I said previously, the extension of Sukari Gold Mines, diamond drill and blast drilling, and a few other ancillary pieces of drilling is a very exciting opportunity for us. I'll talk very briefly about a new investment that we made in our innovation team, which was as part of a raise for echo detection, which is a new technology in continuous water detection. And as part of that investment, we have rights for the mining sector, and I'll talk about that a bit further in the presentation. We continue to have an exceptionally strong safety record, which underpins winning these major contracts with significant customers like Barrick and Perseus, across the region and continuing to get the extension for projects like Sukari. On the 14th of August, the day before we released our results last week, we sold our shareholding in Predictive. We had a 9.6% share in that business. We realised a price of 21 cents, giving us a return of $31 million. The focus of that money will be to pay down debt. We also have an option on those that will give us the ability to continue to earn should that share price, should the company be bought out by either Perseus or another, and we can talk about that in a bit more detail. Just to talk through the growth areas where we've been focused in the business, the Nevada Gold Mines, the significant contract in Nevada, the joint venture between Barrick and Newmont, which will have initially 10 drills. We see a lot of opportunity there for additional drill rigs in that region with the group that we're dealing with in Barrick. They currently operate up to 60 drill rigs, so we see opportunity to continue to grow there. We're building out our labs business there as well, as I talked about. The Belinga project in Gabon with Fortescue continues to grow with 6 drill rigs on the ground now, starting to see the sort of productivities that we would like, and certainly at the upper end of productivity for some of the diamond drills particularly. Lumwana, I talked about the requirement there for the specialist deep reverse circulation drilling that we're doing for Barrick as part of their major expansion of that project. And then the Nyanzaga project that we've won with Perseus for diamond drilling and reverse circulation on that new asset they bought from OreCorp earlier in the year. And then the Reko Diq drill contract, where we've started initially with 2 drills, that's grown to 4, and we've now got another 2 drills about to mobilise, with further opportunities to keep growing that contract. As we transition the business over the last year, we continue to drive strong growth in our business, and we're continuing to develop a broad base of business across both Africa and now the US.
Ladies and gentlemen, I do believe we've just lost Peter. Do bear with us while we just reconnect him.
Sorry, I must have dropped out there for a minute. Enable us to continue to build our business, and we will growing both the labs business and building on the tier 1 assets that we have around the world. This over the last while, our ROCE reflects some of the major investments that we've made, including around $100 million into Gabon, the USA, and the MSA labs business, and they can continue to provide meaningful earning contributions for us. Returns from H2 will ramp up as the US and Gabon and Reko Diq come online, and we continue to focus on long life, high ROCE projects, particularly with blue chip mining companies around the world. And we're continuing to deliver consistent returns in the business, with the business continuing to drive around 20%, which we expect in the second year. The ramp up in the first year has reduced the ROCE that we've had in the first half. We're continuing to invest in our employees and equipment, delivering the top tier service offering and really differentiating ourselves from our peers. We've continued to improve our utilisation into the last quarter and beyond. As we were transitioning some of our drill rigs from West Africa to East, over the first quarter or so, the utilisation was a bit lower, but we expect that to continue back to our target 75% during the second half. Safety records continues to set a differentiated level from our peers. And we've reached a number of key milestones in our business. At Geita in Tanzania, we've been operating for an extended period now with a very long safety LTI-free period. Our Mwanza yard in Tanzania is now 15 years of safety, of LTI-free operation as well. Just for those who aren't too familiar with the business, the five pillars of the business, I'll talk through those over the following slides, and they're easy reference here to go back to after. Firstly, the drilling, which is the core of the business and where we've started, continues to drive a strong ARPU, just over $200,000 in H1. That'll continue to increase as we drive the growth of the business in the US. Utilizations continue to improve as well into Q2, and we see that continuing to improve as we go into the third quarter of this year. I talked about the 2 contracts that we've won, and in addition to the growth that we've got in our key operations as well in Nevada Gold Mines, Reko Diq, and Belinga for Fortescue. Into the second half of the year, we'll mobilise approximately 9 additional drills, a couple of blast hole drills into Sukari, and then the remaining drills into the US, and some new drills into the African business as replacements for some of the equipment that's reached its end of life. I think importantly, one of the other areas that really differentiates us from other drillers is that we're some 90% mine site drilling, which underpins a very steady revenue stream in our business. We are much less susceptible to the ups and downs of the cycle. I think that's a really important part that enables us to deliver consistent high returns to our shareholders. Our mining business will continue to selectively focus on mining contracts. I think one of the things, the Sukari contract, while it's been incredibly successful, requires very large capital. Our intention is to sell that fleet at the end of the contract, and we'll put that into the market later in the year when we demobilise from that mining contract. We've grown our mining fleet down in Gabon with Fortescue. The fleet at the moment is more focused on the drill pad preparation with 6 drill rigs running down there. That's become a large piece of the operation that we need to drive, as well as building roads and other local infrastructure to enable the drilling operation to really accelerate over the coming months. The laboratories business continues on a strong growth trajectory. We have 11 Chrysos units now rolled out, with another 4 units due by the end of this year, reaching total of 15 of the 21. We expect the other 6 units to be rolled out during next year. Slightly behind where we originally planned, but the growth in Nevada, which is both a Chrysos unit and 2 Chrysos units plus a large wet chemistry lab, has pushed out the need for additional Chrysos units somewhat, but we still see a lot of opportunity for that business to grow. We've now continued to build out our customer portfolio. We're doing samples across a number of sites with Barrick, with Perseus. We're doing B2Gold as well, Kinross, Northern Star, Endeavour, Agnico Eagle. Really, the blue chip miners are continuing to move towards the Chrysos technology. I think one of the reasons this is a bit slower than we originally planned, the testing of the units in comparison to fire assay, the mining companies really need to align what they do through fire assay for their resources and into Chrysos. There's not a question about the technology, it's more about being able to align the sample methods, given one's is around half a kilo and one's 50 grams or less. And so there's a reconciliation process, but we've found as the miners adopt the technology, and great examples are places like Kibali, that the fire assays dropped off very quickly, and we continue to move to almost exclusively to Chrysos for that organisation. It continues to deliver the faster turnaround, the ESG benefits, and also process optimization for this technology, and with non-destructive analysis, and we're looking at further automation of the technology to ensure it's as efficient as possible. The labs business now has a footprint of 33 laboratories, including our 7 franchises. We have a Chrysos network across the key gold belts, both in Canada, now in the main gold area in the United States, as well in Nevada. With those units, the first unit is now on the ground, and the second and third ones will be there later in the year. And then also across Africa in both the Birimian gold belt and also in the Lake Victoria gold fields, where a number of our large customers are as well. And our franchise network continues to feed samples into our multi-element lab in Langley. And we are using both the Chrysos units work well to provide us drilling opportunities, as do the drilling opportunities provide us laboratory volumes going through those. And a good example is the new contracts that we have both with Barrick, but also with a number of other customers where we do both drilling, like Perseus, where we drill and also do laboratory samples. Our investments have really delivered significant return, and I think the sale of the Predictive Discovery last week really materialised what we've been talking about. We were able to achieve $31 million, which will leave remaining around $20 million in our portfolio, the bulk of which is the really exciting WIA contract down in Namibia. I think the timing of the Predictive sale certainly was in line with what we'd said in the full year results. When the site had gone to start doing its mine permitting is when it makes sense for Capital to exit. It's generally a different ownership structure, different requirements, and we've realised that a lot of the value. I think the great part of the deal that we've been able to do with Perseus is that there is further upside through a call option and profit share arrangement that we have with Perseus, or should a third party take over, there's also upside provided that happens before the 31st of December next year. On going forward, the bulk of the Predictive funds will go to pay down debt in the business, and we'll continue to look for further investment opportunities like we have done with Predictive and WIA and others. Start small on those opportunities and see where they go. I think that we've proven historically that we've been able to deliver exceptional returns, as indicated in the blue bubble on the top, with a 2.8 times total return versus our net investment of 17.6 million to date in the program. In our innovation part of the business, we've always focused on bringing new technologies or new methods to drive innovation around what we're doing, either at the drill bit or in our operations more broadly. In our Wellforce business, we value add to the holes that we are drilling, whether that's through geophysics, by doing directional drilling, and or for deep holes, and or other value add of orientation of core or cameras down holes and things. I think our training institute in Tanzania continues to grow, which is a fantastic partnership we have with a local organisation to build skills in our sector. We're driving safety improvement programs. We're training our operators from our business and others on specific programs like working at heights and in confined spaces, and are now starting to explore trade skills for individuals, particularly in Tanzania to start, but see opportunities in a number of the other African countries that we work in. We're continuing to look for opportunities with our Mine Power solution, which is a clever technology that balances the use of solar and diesel, particularly for startup operations, whether that's a camp or mine sites building that before they build their permanent infrastructure. And the most recent investment is in echo detection, which I'll go to the next slide to talk about. We made a strategic investment of $7 million in June this year for a 22% of the business. Echo detection, we're looking for a 10 million Aussie raise, and we decided to take the whole amount. In return, we have exclusivity for all of the mining industry globally. So we see a lot of opportunities for us to, on both our mining companies and particularly in early stage of mining, when you want a baseline water quality ongoing for mining operations, where you want to check downstream to make sure there's nothing getting into local water streams or groundwater. And also, I think for inputs into mining operation, quality of water into the plant and into drinking water and the like for operations. I think the technology has a very broad application, particularly in water treatment and water provision across the world, and also into other treatment plants for sewerage and other things, so that water can be tested before it's put back into mainstream water for either underground or into rivers and the like, so that the companies doing that can be assured that the quality of the water is at the levels it needs to be. We expect to start trials with a number of our mining companies into this half, and are in the process of getting a number of units ready to ship to our operations in Tanzania to start some trials in the next few months. On that note, I'll hand over to Rick to go through the financials.
Thanks, Peter. Good morning, everybody. So just to touch on the financials, obviously I won't present them ad nausea, but cover off a couple of important points. So the EBITDA and the EBITDA margin, as Peter has provided context for, off half on half, impacted by the ramp-ups across USA, Gabon, and across the broader labs business. But I think one of the things I wanted to I guess emphasize is our expectation on margin going forward. So we're maintaining our target margin on an adjusted EBITDA of 25 to 30%, albeit at the lower end of that range. I think as we see the business move forward and evolve, as Peter has talked to, the new contracts across primarily USA and Gabon will serve to offset some of the impact of losing economies of scale at Sukari as we reduce our presence on that site at the end of the mining contract. But also those new contracts will serve to offset the lower adjusted EBITDA margins that the labs business will earn. Now those lower margins in the labs business, as we've talked to before, 15 to 20% adjusted EBITDA, they're less dilutive, or we're not expecting them to be dilutive at the EBIT level. So clearly a function of a capital light model in MSA. Let's look at the net debt waterfall. Obviously, this is presented at the half pre the proceeds from the PDI sale, which will obviously significantly alter the net debt position. But just to touch on a couple of points, the CapEx I'll come to talk to on the next slides. The investments is the echo detection investment that we made in the half, and resulting in that net debt at the half there of 86 million. So as you look at just focusing on the CapEx, so in that first half, 44 million of what we call the gross CapEx spend. So cash CapEx with the OEM financing and prepayments added together. And that's in line, or still, we're reiterating our guidance on CapEx for the year of 70 to 80 million. So obviously a touch over the midpoint there, if you like. Reiterating that guidance into the second half. On a net debt perspective, again, table presented pre the PDI sale. So with gross debt there, 126 million at the half. That's reflective of some of that investment, or a lot of investment that's gone into the US, etc. in the half to help with the growth there. That's pushed our trailing net debt to EBITDA ratio up to the 0.9 times. We are still well within our covenants. So all the covenants on the debt facilities are still have a comfortable margin ahead of them. But what I would say is we're probably marginally ahead of our sort of conservative position that we want to stick to internally. So with the PDI proceeds, we have a real strong catalyst to delever the balance sheet. So our intention is to put the $30 or $31 million of proceeds against the debt, targeting our higher cost debt. But straight away, that on a simple math basis puts our net debt to EBITDA ratio at 0.6 times. And then beyond that, as Peter has alluded to, we're actively marketing the Sukari fleet for sale, which will obviously generate proceeds. Timing wise is up in the air because we're early on in that process. It may be that packages are sold discreetly as opposed to all the fleet in one go. But as I say, that process has started. Obviously, the contract is yet to finish. That's due to finish next month. But yeah, we're on our way to hopefully realise proceeds against that fleet. On a dividend basis, we've declared an interim dividend in line with previous years. I think based on what I've said on the previous page, we are very committed to maintaining a strong balance sheet here. So that's sort of taking precedent in terms of the proceeds from PDI. And we'll certainly have a desire to maintain our dividends going forward. Guidance-wise, we're reiterating guidance across the revenue and CapEx, as I've previously touched on. I'll hand over to Q&A.
Perfect. That's great. Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. But just while the company take a few moments to review the questions that have been submitted today, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. And Conor, at this point, if I could just hand over to you to chair the Q&A, that'd be great. And then I'll pick up from you at the end.
Thanks. Yeah, look, I'll go through these. If you keep coming in, I'll be able to keep reading them. I guess we'll start with quite a few questions on MSA Labs. We've talked about, Rick mentioned that our target EBITDA margin guidance of 15 to 20%. Could you talk to that, why that guidance level is there, and also when do we expect the business to become profitable?
Sure. So, Conor, just two parts. So one was what the guidance, the target percentage,
So the 15 to 20%,
and then profitability. Okay.
And then when the timing on it.
So just a bit of background on the MSA business. So we run effectively, really, there's two models. There's a model where we do commercial labs and we target a higher return. And in that business, we target an adjusted EBITDA around 20% across those commercial labs. And then we have a slightly lower return for at which we have 15% adjusted EBITDA, and that adjusted EBITDA flows largely through to EBIT. So you can see, while it's a lower EBITDA on both those businesses, it's very low CapEx across the MSA business relative to drilling or mining. And so that's the lower targets that we have there, but they do flow through into similar overall EBIT to the broader business, around 15% or just under 15%. The MSA business is still in a growth phase, and we expect that during next year we'll move towards profitability, and certainly towards the end of next year we expect to be hitting our overall margins as we've rolled out the last of the units and continue to build up the commercial units that we've now put on the ground.
Thanks. And just on that, you'd mentioned there and earlier in the presentation that our target of rolling them out next year is a bit of a slip from what we originally said. What are the implications on the business, and was that due mostly to the slower adoption from the market?
So not really slower adoption, I think. So the big Nevada contract, as I briefly mentioned in my presentation is about half that is wet chemistry for the business to continue to do some of the traditional methods that they need to do, sort of non-fire assay, but other metallurgical samples and the like. And then also that business it's been a bit slower to roll out there in the US than we'd expected. Some of the permitting, contracting and other things that we needed have meant that that's probably about a quarter behind where we wanted to be. Our intention is still to have 15 units rolled out by the end of this year, and the 21, the remaining 6 of our total commitment during next year. And we've got good visibility on where those additional 6 units could go.
Thanks. And one last one on labs. We originally had a lab at Marilla in Mali. Can you talk to what the unit in Mali?
So we have a commercial lab now in Bamako. So we're now running commercial samples through that and doing testing with a number of mines. But we also are running some samples there for a couple of customers already. And that's in its early stage and growing, that Bamako lab.
Thanks. Move over maybe to a few finance ones for Rick. Quite a few questions have come in terms of what value do you see the Sukari fleet being sold for, and how is that relative to the book value that we hold it at?
Yeah, so book value at the end of the contract will be in the order of mid-20s million dollars, $25-ish million across the fleet. As for proceeds, look, as I said, we're at the early part of that process, so we are expecting proceeds to be broadly in line with that net book value. But look, it does depend on how much of the fleet we decide to sell as opposed to redeploy, and also the timing of that, the proceeds coming in. As I said, we might end up splitting the fleet into discrete packages and selling those off piecemeal, which will obviously take a little bit of time. There's a time and price trade-off clearly. So current expectation is hopefully to sell some of that fleet later this year, early next, with the rest to follow up to sort of over the course of the first half next year, not slightly longer.
Thanks. A couple more from the finance. Firstly, I think we took this to the H1, but it's been asked, why were we holding so much cash at the end of H1 in the context of our debt levels?
Yeah, so I mean, contextually there, obviously we operate in a number of jurisdictions. We have our invoicing cycle and receiving cash into those jurisdictions before we're able to pool the cash up to the centralized sort of cash management level. So I think cutting it at the half there, we did have elevated cash levels reflective of collections at the end of June, but also reflective, you will have seen through the AP, reflective of just the timing of some of the AP when it fell due, particularly in the US, in that movement there. So I think 40 at the half is an elevated cash level. We're typically running more into the 20s, 25 maybe, as a business. Again, why 25? That is a function of the number of jurisdictions we operate in. We need to keep obviously floats within those jurisdictions, and there's a timing component in there around repatriation, etc.
Thanks. And one more, maybe for both of you. What should investors be thinking in terms of sort of a broad target net debt / leverage metric?
Yeah, so I'll please go first. Obviously, as we talked to in the presentation, the current levels of net debt to EBITDA are probably beyond our what we see as a conservative level that we want to maintain internally. So as a target, I would say that sort of 0.6 net debt to EBITDA is a sort of sensible level to have in your mind. But as I say, we've as we have done in the first half, we have gone beyond that to facilitate growth, provided there's a strong payback ahead of it. So as a target, 0.6-ish. But as I say, it's flexible as to what growth opportunities we have ahead of us. And
I think just building on that, Rick, that, you know, we're not saying we want to just pay down debt now and not grow. You know, we will still, for the right growth opportunities, we'll continue to look for those. I mentioned in the presentation a number of places where we see still great opportunities to keep growing. We'll continue to do that in a structured way. I think this first half is a bit of an anomaly in the growth that we've done in 5 different places at once. I think we've got to consolidate over this half, really get those projects to the profitability levels that we need, that we've agreed that we will, and continue to drive the MSA business back to profitability as well. And then that, in the meantime, we'll be generating cash, continuing to pay down debt. That gives us the firepower to go and start looking for additional contracts again, you know, over the next number of months.
Thanks. Maybe up to you, Peter, on echo detection. A couple of questions. An interesting one of if echo detection finds or sees a problem with the water, what does the client then do? I mean, maybe it's helpful to give some case studies of how echo detection has worked in the field.
Yeah, so a great example is there's a couple of really good case studies. One that comes to mind is around in a non-mining application, but I can give you one for mining as well. Abattoirs typically process all the water that they use and store it and test it before they are able to release it. What this technology could then do is enable you to run a continuous testing on the water and either divert it into storage if it's not fit for purpose, or straight into, you know, to enable that to be discharged if it is. Similarly, in the mining operations for us, so we can be giving a mine visibility of where there may be acid leaking from a waste dump or overflow from a storage pond of different types. And so we can give them instantaneously that sort of measure, depending on the, you know, typically most operations would be testing maybe once a week, and unless there's a major event, we can be testing with these units every hour, providing that forward-looking data to customers so that they can be acting. So the echo detection team would proactively provide that back to the relevant mining operation in this case, so that they're getting visibility of data as soon as the test comes through. And unlike a sample that would be collected by a human taken to a laboratory, you've got a time lag. We're getting those samples are being tested continuously, and we can be monitoring whether it's a one-off event or it's something that's continuing, and the mine can deal with it as they need to.
Thanks. And there's a question on just the distribution arrangement around it. How is that going to, apart from just the pure investment part of it, how is it going to affect our revenue and margin? How is that working in terms of distribution?
I think at this stage it's very early days. So we have a distribution agreement for mining contracts. We're just about to start doing trials. It's likely that the models would be on a lease or a per sample basis that we'd send to mine sites, so there'd be a revenue stream. But we haven't really got to a point where we've got a clear model of how that'll work yet, until we really get a good understanding of the size of the market, the adoption rates and the like, and also the types of testing that would be wanted to be done by the mines. So the units can potentially have several different test methods within one unit, and that would drive pricing and complexity of install and things. So, and equally, whether a unit might have a Starlink on it or a solar panel, or those sort of things drive a different cost outcome. But I think there's a revenue stream that will come through a per sample basis or something similar for these units, is where we're thinking.
Thanks. Maybe move one in drilling. Could you talk about the contract we had in Sudan and the status of the rigs we had there?
Yeah, so obviously, with what's happening in Sudan at the moment, that contract is still paused. We've recovered some of the equipment from there. We haven't taken drill rigs out. In a location like that, we would always put older equipment where we're unsure long-term where things might be. So we have relatively low equipment. Some of the ancillary equipment were removed and taken to Egypt. At this stage, Perseus have put people back on the ground, but we don't have clear visibility of when drilling might start again.
Thanks. Maybe one on direct investments. The question is, PDI has been clearly very successful. Do you plan to allocate some of the funds to more investments?
I think the simple answer is yes, but not specifically from this. We expect that we'll continue to find great investments like those and like PDI and Weir, and we typically have started these investments with $1 or $2 million. They're not large investments, so we expect that we'll continue to do that as the method that we go forward. It's worked very well, and I think the knowledge that we have in a couple of our key personnel in the business or directors in our business really give us a very good insight into some of these opportunities, and I think we'll continue to follow that path, but not specifically put a certain number of dollars away from this payment.
Thanks. Question, it might be easier to go back to the slide actually. A question is confused, but which of our labs are commercial rather than mine site labs? Perhaps we can just talk to it at the...
So the mine site labs we have are the Nevada Gold Mines. The Prince George lab at the moment is doing only mine site with samples coming down from Alaska, but we're about to put a lab into Alaska to do that. We have a mine site lab at Kibali, or two at Kibali, 2 Chrysos units, and another one at Bulyanhulu in Tanzania. And then we have the Yamoussoukro lab. While it's a commercial lab, it has a large contract with a mining company nearby. So it's a commercial lab. So generally the other labs are commercial. The franchise labs we don't own. So what happens with those is they prepare samples. They come into our central lab in Langley, and we do the specific analysis that's needed to be done, and there's effectively a revenue share on those samples that come in. Whereas the commercial Chrysos units, we run those completely doing prep and doing those samples. We expect that we'll continue to grow more mine site labs over the coming period. There'll be a couple of others that will be dedicated to mining companies going forward.
Thanks. The question has come on just in terms of our guidance. We've talked clearly in our release and presentation that there's some operational challenges in the first half. What is the confidence level on group guidance and also MSA Labs guidance?
We're still confident to provide guidance in that range for the total year. A number of the contracts that were slow to start are now coming into full run rates, and we've also grown a number of the other early stage contracts. Some of those have come online a bit quicker than we were able to achieve in H1. So we're still confident that we'll achieve within that range on revenue.
Thanks. And I think one last one, unless more come in the meantime. What are your thoughts on M&A in the sector? We've obviously seen M&A across mining, but also in the contracting space. DDH1 bought Longyear, has now gone private. What are your thoughts on M&A in the sector?
I think there's still opportunity. There are a number of specialist drillers. Obviously, they're the very large ones like Boart Longyear and DDH1 and Major. Foraco is similar size to us. I think there's, for us, as we bed down our US operations, I do think that we can grow our presence there, both organically, but I think there might be some inorganic opportunities as well. I'd be surprised if we bought other businesses in Africa. I think we've got a very large presence there already. It would really be for us to get some further geographic reach in our business. But at this stage, our focus is on paying down our debt, generating more cash again, and then we can start to look at that when we're in a stronger financial position going forward.
Thanks. And I got one very last question has come in on remuneration. Can you talk about the STIP, LTIP and how it's calculated and on what basis any sort of bonus internally is done on?
Yep. So the STIP program is based on the results in the year. It's a combination of metrics for across the profitability of the business, the return on capital. We normally have a couple of other specific metrics on growth, and then there's a safety metric. The majority of people also have a personal KPI, which is part of that percentage. The LTIP is based on a 3-year trailing with a based on shareholder return.
I think, Connor, just to add to that, because I can see the question, the zero cost share option concept. I mean, that's a structural point. There's still a performance, so a broader performance driven metric behind that. So, i.e., total shareholder return, EPS accretion over that period, that drives the incentive amount. So the zero cost option is literally the structure that we have adopted, as opposed to it being zero cost share options.
Thanks. And I guess the last one, maybe, so gold's hitting all-time highs. Can you talk about the general impact on the sector and potentially just talk about general demand levels, I guess?
Yeah, I think so. I think part of what generally there's strong demand. I think even with the high gold price, high copper at the moment, I think the juniors are struggling to get funding. So generally, if I look, across whether it's Australia, Africa, or Canada, and I think that's typically what's driven rates in drilling up in previous cycles. I think the majors are being very disciplined while they're spending large amounts of money, whether that's Barrick, Agnico, or Newmont, or other majors. I think that, we're seeing strong demand, but it's not necessarily flowing into rates because we generally do multi-year contracts. So we're not in the market on effectively spot rates at a given time. We have longer term contracts that give us the, stability in our business, good long-term returns as opposed to the ups and downs of the cycle. I think that's probably, if you look at the utilisation of our fleet in the mid-70s again, or 72 on the half, but increasing into this half, I think that demonstrates that there's a strong market out there. But where we see some of our bigger competitors who have a much greater exploration focus have a much lower utilisation, and it wouldn't be until that utilisation really lifted that you'd see rates increase. I think the other thing that while gold is high, the same drill rigs do nickel, iron ore, and other lithium and other commodities. So while those commodities are down, I think it's, the drill rigs and others are available, and so it hasn't seen the same spike of a general increase across all commodities.
Okay, thanks for everyone for the questions. I think we'll leave it there, and I'll pass back to you, Peter, for any closing comments.
Thanks, Connor. Thank you very much, everyone, for joining the call this morning. I appreciate you taking the time, and thank you very much for the questions. Look forward to talking to you on our next investor call, and thank you for joining us.
Perfect, Peter, Rick, Connor, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Capital Limited, we'd like to thank you for attending today's presentation, and good morning to you all.